Liquidity. Liquidity is how quickly you can turn something into cash. Money sitting in your bank account is highly liquid because you can use it immediately. Shares of large companies are also fairly liquid because they can usually be sold quickly. A house, on the other hand, is not very liquid because finding a buyer could take weeks or even months. The easier something is to sell, the more liquid it is. Leverage. Leverage means using borrowed money to make a bigger investment. Imagine you have $10,000 but borrow another $90,000 from a bank. You now control a $100,000 investment instead of just $10,000. If the investment goes up, your gains become larger. But if it goes down, your losses become larger too. Equity. Equity simply means ownership. If you own 20% of a company, you own 20% of its equity. The more equity you own, the larger your share of the business. In real estate, equity can also mean the portion of a property you truly own after subtracting any debt attached to it. ROI. ROI stands for return on investment. It measures how much money you made compared to how much money you invested. For example, if you invest $1,000 and make $200 in profit, your ROI is 20%. Investors use ROI to compare different opportunities and see which one performed better. Market cap. Market cap is short for market capitalization. It is the value of all a company's shares combined. The formula is simple. Market cap equals share price times total number of shares. If a company has 1 million shares and each share is worth $10, the company's market cap is $10 million. Investors use market cap to quickly estimate how big a company really is. Asset. An asset is anything valuable that makes you money or helps you build wealth. Examples include stocks, rental properties, businesses, and cash. Imagine you own a rental house that brings in $1,000 every month. That house is an asset because it is putting money into your pocket. The more assets you own, the easier it becomes to grow your wealth. Liability. A liability is something you owe. Loans, mortgages, unpaid bills, and credit card debt are all liabilities. Assets help build wealth. Liabilities usually reduce it. That's why wealthy people try to increase assets while controlling liabilities. Net worth. Net worth is the value of everything you own minus everything you owe. The formula is net worth equals assets minus liabilities. If your assets are worth $500,000 and your debts total $150,000, your net worth is $350,000. This is one of the most common ways to measure wealth. Revenue. Revenue is all the money a business brings in before expenses. Think of it as total sales. If a company sells $1 million worth of products this year, its revenue is $1 million. But revenue does not tell you how much money the company actually kept. Profit. Profit is the money left over after all expenses have been paid. If a company earns $1 million in revenue but spends $700,000 operating the business, its profit is $300,000. Revenue is money coming in. Profit is money left over. If you're learning something new, hit the subscribe button. Cash flow. Cash flow is the movement of money in and out of your finances. Imagine you earn $4,000 every month, but spend $3,000 on bills, food, and other expenses. You still have $1,000 left over. That means you have positive cash flow. If you spend more than you earn, you have negative cash flow. Interest rate. An interest rate is the reward you earn for saving money or the cost you pay for borrowing money. Imagine you put $1,000 in a savings account that pays 5% interest every year. At the end of the year, the bank gives you $50. That's your reward for saving money. The higher the interest rate, the more you earn on your savings. Compound interest. Compound interest is interest earned on both your original money and the interest you've already earned. Imagine you invest $1,000 and earn 10% interest. After 1 year, you have $1,100. The next year, you earn interest on $1,100 instead of $1,000. That means you earn $110 instead of $100. Your money starts making money on its own. That is why compound interest is often called the most powerful form of investing. Inflation. Inflation is the gradual increase in the prices of goods and services over time. As inflation rises, the purchasing power of your money falls. What $10 can buy today may not buy the same tomorrow because prices have increased. This is why money left sitting around slowly loses value. Credit score. A credit score is a number that tells lenders how trustworthy you are with borrowed money. In the United States, credit scores usually range from 300 to 850. A score above 700 is generally considered good. A score below 600 is usually considered poor. Paying your bills and loans on time usually increases your credit score. Missing payments, defaulting on loans, or carrying too much debt can lower it. The higher your score, the easier it becomes to get approved for loans, credit cards, and even better interest rates. Diversification. Diversification means spreading your money across different investments. Instead of putting all your money into one stock, you invest in multiple assets. This reduces risk because one bad investment is less likely to destroy your entire portfolio. It's the financial version of not putting all your eggs in one basket. Stock. A stock represents ownership in a company. When you buy a stock, you become a small owner of that business. For example, if you buy shares of Apple, you own a tiny piece of Apple. If the company grows and becomes more valuable, the value of your shares can increase too. Dividend. A dividend is money paid by a company to its shareholders. Think of it as a reward for owning the stock. For example, if you own shares in a company that pays dividends, the company might send you money every few months just for being a shareholder. Not every stock pays dividends, but many large companies do. Bond. A bond is basically a loan. Instead of borrowing money from a bank, a company or government borrows money from investors. In return, they agree to pay interest and repay the money later. Bonds are generally considered less risky than stocks. Volatility. Volatility measures how much the price of an investment moves up and down. A highly volatile stock can rise 20% one week and fall 20% the next. A less volatile investment tends to move more slowly. Higher volatility usually means higher risk, but it can also mean higher potential rewards.